I spent a lot of time with Nelson, and one of the things that Nelson and I would have the longest conversations over is the word recapture, because it's one of those things where I differed with him on the definition of that word, because it's really funny, but I look at it and I go, okay, what does recapture mean?
Well, Tom, thank you for joining us on the Infinite Banking Initiative. Let's start off by hearing how you discovered the infinite banking concept. Share with our listeners and our viewers that story for you.
Awesomely. Well, I'm so glad to be here, and I really appreciate you guys having me on your podcast. So I listened to, just randomly, I heard a podcast, and this is going back to, I mean, it has to be 2011 or so when I heard this podcast, but it was Nelson discussing the concept of saving money in life insurance, and, using that to be able to fund different things in business and things. And I am a contrarian by nature, and was very much inspired by libertarian thinking and Austrian economic theory. And when I heard Nelson talking about that, I was immediately sucked in, and I was like, okay, I have got to learn more about this. And so I started, diving in and reading everything I could. Of course, I got his book and read that, Becoming Your Own Banker. And then I went to a conference. I mean, it was a long time ago, David. It was the first conference that you invited people to start a practitioner program. So I was in the first class that you guys did when you very first started up the practitioner program with Carlos and Bob and
2013.
Yeah, it was 2013 is when I started with Infinite Banking. So I went to that first conference, heard Bob Murphy speak, heard Nelson speak, heard Carlos Lara speak, and I was like, okay, this is something that I absolutely love and was very excited about. So that's how I originally found out about it.
12 years ago, you're still excited about it, right?
I totally am. Yeah, I mean, I love it, honestly. So, I mean, the reason that it resonated so much with me, you guys, is because I was just coming out of a very difficult time in my life, because I was in the music industry for a super long time, actually 29 years in the music industry. And I got to do some amazing things in that business. I was actually one of the more actively involved people in the pop and contemporary Christian music scene in Nashville. And I got to work with hundreds of amazing artists, and, including Bruce Springsteen and REM. And, in the Christian world, I co-produced Michael W. Smith's largest selling record. It was called Worship. So I definitely was super active for a long time in that field. And then I lost partial hearing in one ear, meaning my high frequencies went away. And it was due to an accident in the recording studio where, long story short, it just blew out my hearing. There was a problem, and I had put in place a long-term disability policy. Okay. So I know that this is not infinite banking, but it was something that my financial advisor said, look, you need to get a policy because you're making so much money using your ears. You need to get a policy to protect your ability to earn a living. And that was one of the most important decisions I ever made, was getting that policy. So I ended up getting a policy through Guardian, is who it was. Just, throw that out there. They were awesome to deal with. And it was an own occupation long-term disability policy. Of course, I didn't know that then because I was in the music business, but I know what it is now. And when I lost hearing in the music business, I had 5 years, because there was a 5-year window to go back to school and learn anything I wanted to learn. And I was getting a really good monthly tax-free benefit from that policy. So that is when when all this went down with me learning about infinite banking and learning about how all of this worked. And I was like, you know what? I can't really do music anymore. And if I didn't have this policy, I would be basically working at Home Depot. I mean, that was my main skill, was doing that. And so I decided to go back to school with the time I had. I went back to school, and what I did, to be honest, was I started going through all of the courses in the program called CFP, Certified Financial Planner. And I realized as I was learning everything that they teach those guys, and then I was learning about infinite banking, that they don't teach in traditional finance how any of this stuff works. It's literally an inch deep and a mile wide, and there's no depth to that knowledge base. But it was good for me because I was coming from a totally different industry. So I needed to sort of learn what the universe of things that were out there in the world. And going through that program, I ended up not becoming a CFP, but now I have 4 financial designations because it taught me the value of just learning stuff. And I ended up going and getting a chartered life underwriter designation, which was amazing. Back when I did it, it was a ton of classes. Now it's down to, I think, 5 classes, but it was a lot of education you had to go through. And then when I finished that, I got a chartered financial consultant designation. And then I got a chartered special needs consultant designation. And then the one I just finished, interestingly, last year, because I just kept going on my learning journey, was a retirement income planning specialist. So I just finished that as well, which I'm super thankful to, I'm super thankful that that kind of education is out there, because I think it helps you become better at really being able to look at a holistic viewpoint on what a client needs and how to help them. So that's kind of a little bit about my background.
You say you had a 5-year disability annuity every month.
Yes, sir.
And so how far did you go into that 5 years before you finally got totally focusing on what you were going to do and you could wean yourself off that?
That's a great question, David. It was the full 5 years I ended up taking to go through and really get all of I think I got my first 3 designations in those 5 years. So I used that time to just study the whole time, because I knew that I didn't want to start the way a lot of people start, especially in financial services, is that they sort of like shoot and then they aim. You know what I mean? It's like ready, fire, aim rather than ready, aim, fire. And I think that for that reason, it churns through people very quickly. I mean, there's such a high turnover in the financial services world because people tend to start before they know what they're doing. And that's just the common way it goes. And so I decided, no, I don't want to start by calling all my friends and family. So I never talked to any friends in the music industry or my family about what I was doing. And I did not do that route. I ended up really, truly starting with trying to help families who have loved ones with special needs. That was the target market that I went after for the first few years. And I got to be totally honest with you guys, it did not work. It was just, I was pushing a string up a hill, and I didn't connect or resonate. Whatever the message that I had did not work. And so I ended up pivoting after a couple of years, and then it's just been smooth sailing for the last, 10 years or so after I found my current target market. So my current target market is small business owners and real estate investors, mostly real estate investors. So and I have a ton of clients that are pilots for some reason as well. So it's unique because what it is, you guys, I figured it out. Pilots have a massive amount of time on their hands because they're on layovers all the time. And they do a lot of research on just everything under the sun. And they're very detail oriented and can follow directions amazingly well. So there's something about pilots that make great clients for me personally. And real estate investors, The reason they make great clients is because they're not doing traditional finance anyway. They're already not loving the stock market and wanting to do something that gives them control of their money. And so they resonate really well with this strategy, of infinite banking.
Well, by definition, a real estate investor, that's their wheelhouse, and that's where their money's going to go. The idea is how do you efficiently, effectively recapture all that money, cash flow in your investment or your real estate portfolio or whatever your business looks like.
Back to my days with Nelson. Okay. So I spent a lot of time with Nelson. And one of the things that Nelson and I would have the longest conversations over is the word that you just used, and that is recapture, because it's one of those things where I differed with him on the definition of that word, because it's really funny, but I look at it and I go, okay, what does recapture mean? That means that you're getting back something that you'd already lost. But in reality, in order to capture it in the first place, you have to have never lost it. So there's just, I don't know, that word is just one of those things where it is one of the most tricky words that I hear people throw around in the banking circle, infinite banking, whatever you want to call it, that I'm like, okay, I don't know about that. I never use that word, because for me personally, I'm trying to help them avoid losing something. That way they never have to recapture it. Does that make sense, David?
Yeah, that makes sense. After you started that, I do remember those early conversations, emails or sidebars,
I remember we were on a podcast or something. I don't remember what it was, but that whole thing came up and I was talking to Nelson about it. And I remember having dinner with him one night. I think it was in St. Louis at one of those E3 events. Do you remember that when he went there? And so we talked about that again one time there. So yeah, it was one of the things that I was like, man, I don't understand how everybody's using this word, because from my background, it was like, what the heck are they talking about? So anyway, long story short, that just reminded me of a definite memory I had with Nelson.
When you first started getting into the infinite banking space, can you expand a little bit more on some of those challenges that you had to overcome, especially working with clients in those early days?
So there's obviously a huge hurdle to climb for anybody doing infinite banking, and that is that there's this negative perception about life insurance, and specifically whole life. Okay, it's just out there. I live in Tennessee, basically, ground zero for the Dave Ramsey world, and so you have to overcome that initial, hey, everything is bad about it, and so that's definitely a challenge. I don't have that challenge anymore, just because if somebody is now working with me, they're already, I don't know how to describe it. They were already gone through that filter, I guess you could say. Like, I don't talk to anybody where I have to overcome that negative challenge anymore. But early on, that was, of course, was a biggie. Another thing early on that I was, struggling with was trying to find who could best benefit from what I'm teaching. And that was, like I said, I picked the wrong market. I ended up getting a designation in special needs planning and working with a lot of families who have loved ones with special needs, and it worked out great. But it was always like, I'm a pilot who has a loved one with special needs, or I'm a real estate investor who has a loved one with special needs. In other words, that was there's a lot of that out there that you have to plan for. So I'm working with somebody now to get a special needs trust set up and finding them the right attorney to work with and connecting them for, picking out what kind of trust they're going to do and, what kind of policy, life insurance policy they're going to do that most effectively will fund a special needs trust. I mean, there's a lot of challenges involved with making sure that you do that right, because it's a big deal if it gets done wrong, And so I end up doing it, but it's more of a sideways, thing than a direct deal. So anyways, the early challenges I had was not picking the right market. And my message just didn't resonate. And Yeah. So that's what I would generally say, but that's a great question.
Yeah, so I guess special needs, like you mentioned, trust or whatever. That's probably the central focus of it, is to protect the child or the adult or whatever, and make sure that they're taken care of whatever happens to their parents or whatnot. So the central focus is, I guess, setting up trust and whatnot.
You set the trust up, and then there's also special types of life insurance that sometimes can really work. Survivorship, whole life policies are a big thing, or sometimes known as second to die policies. Are good to be able to use as a planning tool for that. Yeah, there's a lot of just unique things that you have to be aware of. And honestly, I really am so thankful that I went through all the different educational paths I have, because I try to look at, okay, how is infinite banking going to fit in with everything else you're doing, and not just talk about infinite banking. It's really kind of hard to describe, but I just this week I was talking to a potential client that is actually going through underwriting right now with me, and I'm looking at holistically what's going on with them, and I'm like, okay, they were recommended some stuff, and I looked at it and I was like, this is not really fit you for a suitability standard, like what is reasonable for what you're doing. A lot of people discount their need for life insurance personally, and the core concept behind traditional straight up infinite banking is to put in as much money as possible for the least amount of life insurance, which is good to do because that accelerates the cash value in it as much as possible. But then you have to also look at income replacement. For example, you want to look at what are their needs if something were to happen to them. Is this going to be enough to really cover income replacement for their family? And if you don't supplement that in some way, I like to personally use convertible term insurance to supplement whatever they're doing whole life wise, so that it gives them the option to convert that to a second whole life policy later if income increases. But during the interim time, they are covered if something were to happen to them. So, it's just that kind of thing.
No, it's got to be a holistic approach. IBC is foundational, at least, from my perspective, but that's why there's no IBC is no cookie cutter fix for anybody. Now, if you look at Becoming Your Own Banker, all the vignettes and illustrations in that book, I think we have Nelson has 5 or 6 different policy designs in there, and the biggest YouTube IBC message out there is, like you said, get as much cash surrender value in there as in with a little premium, which equals a little death benefit or whatever. And that's like no. I mean, each policy design is different than mine, and it's different from yours and different from your clients. I'm a very conservative policy design individual myself. So yeah, I'm getting you. And every week when we talk to different practitioners, the need for death benefit, it rises to the surface very quickly. And it's absolutely critically important. I'm glad you mentioned that convertible term, because that is a great tool. And that, insurability, is critically important also, right?
Yeah. And I do use it, and it's incredibly powerful, especially because I don't know what it is with real estate investors, but a lot of them eventually like to get their pilot's license. They like to start flying. It's just a thing. It is a thing. I don't know what it is, but I think it's because there's a certain freedom involved in being a pilot, and also I think they like to fly around and look and see what the area is like. I really do. I think that there's some connection there, but I can tell you, when you first get a pilot's license, you can forget about getting any kind of reasonable life insurance. I mean, they throw $5 flat extras around like it's popcorn when you just are learning to fly. And that makes the whole thing really not doable. So I try to lock people in with the best coverage that they need, not over what they need, but what they actually need so that they can convert it later. Even if 5 years from now or 2 years from now, they decide to become a pilot, then they still have that lower rate. That's just one of the things that I've seen.
In today's real estate market, I guess there's a lot of profit, so you can spend that money and buy airplanes and fly around and look at your real estate developments from 10,000 feet, right?
Yeah. I mean, I wouldn't say that was a thing. I never would have until I've actually dealt with a lot of it. I really have dealt with a lot of clients that decide to get their pilot's license, and just to start. And honestly, if you're an experienced pilot and fly commercially, it's no problem, right? Because you know what you're doing. But the insurance companies just do not like starter, hey, I'm going to go get my license. They do not like it. It's just like, how many hours do you have? Oh, I got 10 hours of flying. It's like, get out of here,
Come back in 5 years.
Yeah, exactly, David.
You survived it. You survived that 500-hour transition when it's the most dangerous. Because now you're confident in your abilities when you're really not that good.
Yes, exactly. That's
I get it. I guess there's a military problem too. But again, individuals insured too. That's why the government takes care of our military insurance.
Yes, I mean, if you're not likely or very unlikely to be deployed in active combat, you could do a desk job and be in the military and you can still get coverage, but it is tricky for sure. It just depends on what you do.
Do you live in Nashville or you live in the metropolitan area?
Metropolitan area. Right now I'm in about a half an hour south of Nashville in Murfreesboro. So yeah, it's a great area. It's really close to the airport. It's really nice.
Well, Nashville is one of the explosions out there when it comes to metropolitan growth, right? So a lot of your clients are local. That
is so funny that you bring that up. And the answer is 100% no, they're not. I literally have almost no Tennessee clients. I'm licensed in I've pretty much all 50 states. And the concentration for me is California, Texas, Utah, Florida. Those are my 4 biggest states. And then it's kind of like a mix after that, just like all over the place. But Tennessee, because there's such like a stronghold here on, whole life bad, it's somehow it's more pervasive here. I don't speak at many conferences locally. Number one, like I'm just signed up to speak at a real estate investing conference for military people, actually. And it's in San Antonio, Texas. So, and 3 weeks ago, I spoke at a conference in Salt Lake City. So I kind of go all over the place. I think I'm speaking at a conference in Tampa coming up as well. So the people in California, in Utah, Florida, and Texas resonate very well with this concept and seem to have no hangups about it whatsoever. And there's just pockets. I don't know what it is, though. I don't completely understand that. Have you guys found that at all?
Yeah, I mean, mostly it's the Northeast in general terms. If we get a New Yorker or somebody from Massachusetts or Connecticut to understand what the concept's about, then it's a win-win. Because they're so traditional up there in the markets and qualified planning and whatnot. So it's just.
And I will tell you this, I have some clients in New York, but I try to avoid New York like the plague because of their regulatory environment is horrific. It's just very difficult to get business through, and you just have to go absolutely nuts with the paperwork to get anything going in New York. So it's very difficult in general, but anywhere else but there is great.
They need IBC just as bad as anybody needs it.
I totally agree, David. I totally agree. Yeah. One of the things that I call my strategy is bulletproof wealth. And the reason I came up with that is because I wanted a name that incorporated infinite banking, but wasn't exclusively infinite banking. So I talk about infinite banking and people want to know about infinite banking. But when I'm talking about everything I do, I call it bulletproof wealth because there's some stuff I do that differentiates the traditional infinite banking. And I'll tell you, one of them is that I'm really big on, if something happens to you, like it happened to me, and you can't work, what's going to happen to your policies? You know? And so I'm very a big proponent of what's called disability waiver premium riders, so that if you get sick or hurt and can't work, at least the minimum on your policies are going to get paid. Okay. And those you can put on people up to age 55. So that's one of the things that I do. A second thing I do is holistically look at their actual need for life insurance and make sure it's covered. And if they need to, I add convertible term. And the third thing that I do that is really different than traditional infinite banking is I always have a discussion about long-term disability. Just straight up, this is not infinite banking at all. This is just, if you get sick or hurt, will your income be replaced through you not being able to work, which is exactly what happened to me. So it's an easy transition for me to talk about. But all of that kind of wraps up into what I call the bulletproof wealth strategy, is adding that protection layer of what happens if you can't work. So I want to make sure your policies don't lapse, number one, and I want to make sure that you have income coming in, and it happens more frequently than you would imagine, that somebody can't work for whatever reason. It's usually due to a sickness or an injury of some sort.
You said it is more frequent than you suspect. So, do you have like an idea of your clientele? What does that look like? How many people are exercising those riders and whatnot?
So yeah, definitely. We're working right now with somebody who, what was it? I mean, I don't want to go into the specifics, but it's some sort of illness that they have that prevented them from working. They were a pilot. Okay. And, the pilots have to go through these rigorous physical exams every 6 months. Okay. And they run you up one side and down the other to make sure that you get recertified to fly for the next 6 months. And stuff comes up on those physical exams that they have to do. And honestly, I think it's good, because you don't want a pilot up there in the middle of a flight and then something goes wrong. So they don't mess around with just, letting somebody's health go to heck and then still let them be a pilot, especially of a major airline. And so anyways, yeah, because of that, it all works together, and people find illnesses kind of before they become critical, but then they make it so that they can't, hey, you're grounded, And so if somebody gets grounded, then they call me and say, hey, I need help here. I've just been laid off for the next blah, blah, blah time. And of course, there's always an elimination period. Usually what I do is 90-day elimination, because it's the most cost effective. So they have to have some savings, to cover them for the first 3 months. And then it'll kick in on their disability policy. And then there's also an elimination period on the disability waiver in their whole life policy as well. So, I don't know how many practitioners are doing this kind of stuff. Do you guys have a feel for that? Because you probably would know better than me.
Not really. I mean, I guess there's two ways to look at it. Number one is a disability, like a term policy, right? Or are you talking about disability waivers within the whole life context?
I'm talking about disability waiver within the whole life. I also put disability waiver on the term insurance, because you don't want that to lapse either, and it's not that expensive, David, but there is a window that you can get it. So you can't get the disability waiver added to a whole life policy if you're older than 55. Okay. That's kind of the cutoff.
You can add it to an existing policy, or do you have to declare it upon underwriting initially?
So you have to declare it upon underwriting initially. Yeah. And one of the cool things about getting a convertible term policy with a disability waiver is that you don't have to requalify for the waiver when you convert it to your whole life policy. It automatically goes on the whole life policy, which is really a super neat thing. So it doesn't matter that much if they, because they could probably come up with the money to pay their term premium, but having that waiver on their term policy really matters if they're converting it to a large whole life policy, because now we're talking about real money, that it waives if something happens to them.
you experienced it personally. You know the benefit of it and how it can impact somebody's life. So, I could see that would be part of your lifestyle in your business,
It is, man. And it's an easy story to tell because it all was real and it all really happened.
I don't think we ever talked about that on the podcast before and the importance of that and how that works and whatever. So I'm glad you brought that up. How do your airline pilot clients, real estate investors use the concept IBC typically?
It depends on what they're investing in real estate. So the real estate world is very diverse. It's kind of like saying, what do people invest in the stock market? There's a million different stocks. There's also a million different ways to do real estate investing. So I have some clients that do self-storage, for example. I personally do that as well. I co-own a self-storage facility. And that's more of like a buy and hold strategy where you buy the facility and then you basically just hold it and make income coming off of it. Then there's people who do mobile home park investing. I have some clients who kind of specialize in that. Some people who invest in apartments, and that's more of like a 3 to 5 year hold. So basically you're using your money into typically a syndication, and those usually have a $50,000 to $100,000 minimum. So they kind of have to have their policy built up a little bit before they can do it, but they're typically getting 2-to-1 returns on a 3 to 5 year hold in a in a syndicated apartment complex, meaning if they put in $100,000, 3 to 5 years later, they're getting back 200,000. And they also typically get paid some sort of interim distributions on a quarterly basis, which I recommend them using that to pay at least their interest. Because I don't like compounding interest. And I don't know, I teach my clients to avoid compounding interest at all possible costs, which means keep your policy's interest at least wiped out on an annual basis, because the interest does compound on the policy anniversary. So if you have 5,000 in interest, accrued, it will then start compounding on that 5,000 when your anniversary ticks over, which is just one of those little details that not many people think about. But so the biggest thing they do though with the money is what's called fix and flip. That means they purchase a undervalued property, fix it up, and then resell it. So they're only needing the money for 6 to 9 months while this whole process is going on. And one of the things that they especially love about being able to borrow against their cash value from their whole life policy is that they don't even have to pay the minimum interest while they're utilizing their money inside, while they're utilizing the borrowed money inside of their, fixing up their property. So then when they sell it, they pay back the loan, and then they have the profit that they can keep, and then obviously put it in on the next time premium it comes up as available. But it works phenomenally well. It really does.
I guess it's different for different insurance carriers also. But, a key, if you're doing a policy loan, correct me if I'm wrong, Tom, if you're doing a policy loan, and for the company that I use, I get pre-charged all the interest on that loan, right? Okay. And the key date on principal and interest payments is the policy renewal date.
Right. I call that the policy anniversary. Yes.
Anniversary. And that could be 12 months from the day you take the loan, or it could be 12 days from the day you take the loan. It's all, you got to know when the anniversary day of the policy is.
Yes. It's not just to be clear, not a calendar year. It's whenever your specific anniversary is.
Okay. You're right. So if you do a $10,000 loan for a flip and you're pre-charged 5% interest, then your ledger says, $10,500 is the number. On the anniversary date, whatever principal and interest you have on the ledger is recast for the following year. Okay. But if you pay the loan off completely, the $10,000, not the interest, just the principal, then the interest is rebated to you. So you're not charged. You're not charged interest. It's simple interest. Is that correct?
So yeah, every company does that slightly differently. The one that I do a lot of business with, and I'm not exclusive to any one company. I just go to wherever it fits the need of the person, and kind of based on what their specifics are. But the one that I do a lot of business with, it's simple interest for the first 12 months, and then it compounds on the policy anniversary. So they honestly they give you every possible opportunity to clear that interest off, because they don't want to carry interest over and have you pay compound interest either. So I am very strong advocate of, hey, if you don't have the money to pay back the loan because you haven't sold your flip, at least pay the interest off.
Yeah, that's my personal strategy also. I always, in our family banking system, that's what I always encourage my family to do the same thing. But if I was one of your real estate investors, I would personally continue to try to make monthly payments or quarterly payments on my loans, regardless if I sold the property or not, because that gives you the flexibility and that gives you the capability of saving more money. Okay. And we're talking about cash flow here. So, if you had a conventional loan for your real estate investment property, you would be forced to pay principal and interest over the course of the loan, but whatever the terms are. So why don't you tell your clients to do the same thing with an IBC loan? That way you would, the numbers would look much larger at the end. I know some people can't do that, but that's how I think about how to do this.
Well, the cool thing is, because it's your own privatized bank, you have the control there to be able to do that if you have the money. But if you don't, and you need that extra bit to finish to get over the hurdle, then you can do it when the property sells. And these guys are not holding their properties for years. It's months. So it's a shorter amount of time. So there's not a ton of accrued interest, unless, like you said, which is a very good point, it happens to compound and they took a loan, a month before their anniversary, then I would say go ahead and pay it off for sure. But, you kind of got to give people these are, put on your big boy pants and understand the ramifications and what you're doing here. But I give them the control to go, yes, I'm going to pay back the interest, every month, or no, I can't do it right now, but, maybe I will the next flip. It just depends on where their cash flow is looking like. But I mean, this saves them so much, David, versus doing hard money, right? So that's the alternative, is that they're doing hard money loans, and then those loans are egregious really on the interest rates. They're not giving away that money. You're having to prepay points, and then you're having to pay, at least like 1% per month. So it's like a 12% rate, and usually 1 or 2 points to get the money. So it's difficult. And this puts them in the position of getting a very low interest rate, traditionally, low interest rate loan.
Yeah. I didn't even think about prepaying the points like that. Man, that's a big benefit of using an insurance company policy loan.
Huge, because they usually call it origination points, right? So they'll do 2 points to get the loan. Well, that's $2,000 on $100,000, boom, and that's just gone. And that means if you paid back the $100,000 30 days from now, you're still not getting back that origination loan fee, the 2% origination fee. So yeah, I think that the tricky part for real estate investors is they need to get their line of credit that they can borrow against as high as possible, so that it's really usable to them. Because a $4,000 or $5,000 line of credit is not going to do anything. 10,000, not really. 20,000, barely. I mean, they need to get in the 50 plus range in order for it to be like, yes, now this is something I can go to and make it work. So that's the tricky part. And usually, like some people are just willing to wait until it gets, up to that point. But usually real estate investors are pretty antsy. They want to use, just in general, like my personal CPA is a client, and he's like, I'm not taking a loan. This is conservative, right? You'll love this, David. I'm not taking a loan until the 7th year when my policy values are equaling my premiums paid. And I'm like, okay, that's cool. You can do that. That is not required, though. You don't have to wait that long. But that's just the way he wanted to do it, which I applaud that. I'm like, yeah, go, do whatever you feel comfortable with, and some people are a lot more conservative than others.
Well, I talk to people all the time that are love IBC and they buy these beautiful policies and they never use them. But yeah, I was doing a presentation at one of our events a couple of years ago, and one of the things I do is I show our spreadsheet, all the policies every time I have an anniversary and I pay and whatever, I update the spreadsheet and I show it. And I'm so proud of my spreadsheet because, man, look at all these policies and look at this cash surrender value and look at this great death benefit. I'm doing so great. And so somebody came up to me after the presentation and said, you're not doing IBC. I said, I was hoping nobody would notice that. And it's so for everybody listening today, if I have this beautiful system of policies, but I'm not doing IBC, what does that mean? What's the definition of not doing IBC? You have an answer, Lee?
Not utilizing your policies.
Yeah, I had no loan activity. So I said, yeah, you're right. So I went home and I told my wife, we need to do some loan activity.
If the opportunity is not there, David, don't force it. You know what I'm saying?
Instead of, spending cash, then you might as well policy loan and get the money back in the policy to keep it going. But yeah.
One of the last designations that I got was the retirement income planning specialist. And one of the things that getting that designation really opened my eyes to, and it was really, I would say it was the big aha moment from going through all of that work to get that designation, was people don't need a number in retirement of money sitting in something. They need income in retirement. That's what you need, right? And the thing that is wild about having, and this is back to what you were just talking about with having a bunch of money in your policies, is the money that is there can produce more income because of because of the dividends that, of course, the dividends are not guaranteed, but because of the dividend growth that is very likely to continue, you can turn the cash inside of a whole life policy into much more income than you could if it was setting anywhere else that I know of. I mean, it's crazy. So it's like, would you rather have $4 million in a stock portfolio or $4 million in life insurance when you turn 68? I'm telling you right now, it is not even close what you can do with the money.
We're not even talking taxes. We're just talking about the ability to earn income off that repository, quote unquote. And if you go back to Nelson's vignette about a state farm policy, I'm sure you remember that one. A tiny little policy, and it's like his annual premium was like $488 a year, and his annual dividend was like $5,000 a year. But long story short, he goes, that's pretty good, isn't it? And everybody go, yeah, man, that's great. And he said, but that's nothing. What you're not seeing is what we did with that policy, and most of it was real estate investment. Because he was a forester, so he'd buy raw land and flip it. But yeah, same thing you're saying, that that's the real benefit. You're right. And the big moniker now I see on YouTube is like, how much money do you need in retirement? Well, $1 million. How long can you live on that? It's like, no, you're looking at it the wrong way. That's a good point.
Yeah, and it is really. I mean, I saw my own parents go through this. They had a large amount of money saved that they worked their whole lives to save. It was in the stock market in qualified plans. And I'm telling you, they did not want to take it out. It was literally like pulling teeth to get them to spend money in retirement because they didn't want to pay the tax on it, because this was pre-Roth. And so there was no tax-free distribution. They were paying tax on everything. So they would take the minimum distributions and then reinvest it back in the stock market and live on Social Security. And I'm like, what are you guys? I mean, it was a mind blower, but I saw how people think. And what it is, David, is that there's a possibility you're going to run out of money. It doesn't matter what the amount is, because you can always lose a big percentage of it if it's at risk, right? So unless you have some sort of predictable income like you would get from a whole life policy, then it gives you a lot more comfort in knowing this is going to last at least till I'm 100, and I don't need to stress on it. I can use it, if I distribute it right, which is taking the basis out first and then switching to collateralized loans after the basis is done, then there's no tax. And if I build up a giant loan, the death benefit's going to pay it off. I mean, it's just so awesome, and people miss it. They do. They miss that benefit a lot.
When you got the retirement income specialist designation and you went through that course, did that really reinforce what you already knew about life insurance?
So yeah, that designation does talk a lot about insurance and annuities and how powerful they can be. They use it as what's called an income flooring strategy. So if they're saying, hey, in order to keep the lights on and maintain your lifestyle, you need $2,500 a month, but you would really like $7,500 a month, then make sure you have a floor that's going to pay that $2,500 no matter what. And a lot of that can be accomplished through insurance products. They didn't necessarily really explain whole life so much, but I know how whole life works. And I know that has better tax advantages than an annuity due to the exclusion ratio. It's just a better place to get money than an annuity if you have it. But of course, you have to put it there over time. You can't just drop it all in, 2 years before you retire. It doesn't work that way. You have to have been planning early for it. So it's really, I'm telling you, it's huge. And something that people miss is how important it is just to have money in whole life before you get to retirement, and how that money is, $2 million there is worth more than much higher numbers somewhere else. I guess I'm just throwing that out just to put a number to it. I'd rather have 2 million in whole life than 2.5 million in the stock market for sure.
I'm a layperson. I don't have any designations in the financial services industry anywhere else across the planet. But, I dealt with my father's estate. And it's the same way. He had a couple of annuities. He had a mutual fund. He had military retirement pay. He had state teachers' retirement pay, and he had Social Security. And those three retirements, military, state teachers, Social Security, was more than enough for him to live on a monthly basis by a factor of two. And so he'd look at these annuities and he goes, "Why do I have these?" I said, "I don't know. I mean, and then he had a mutual fund, and he said, my income is, basically, I'm a W-2 guy on retirement pensions. And so why am I paying $8,000 or $9,000 in income tax every year?" And I said, "Because you have a mutual fund." "But I'm not taking any money out." Well, guess what? When the market's good, you're getting charged, man, because they're reinvesting your fund, and you're earning those interest credits are taxable. And so just like, and before my mother passed, I kept trying to get her to start taking distributions out of those accounts and buying whole life insurance on her kids. They wouldn't do it. Wouldn't do it. And so my father, like 10 years later, that light bulb was finally coming on for him, but it's like, hey, it's too late. You got to suck it up, man.
I think another thing people really discount is what's called sequence of return risk, which means that as they get closer to retirement, if they lose a large amount of their retirement that they had saved due to a single down year, it is really bad, because now they have to start withdrawing. So you just do not want to have your money at risk as you're getting closer to retirement. It just doesn't make sense.
Well, come on, man. Dave knows how to do it, and he's telling people to do it.
Hey, you know what just cracks me up about him is that he's been dogmatically holding to the fact that you can get 12% in a good growth stock mutual fund for like 30 years. He's never changed his tune on that. honestly, that's never been true. I just don't know how he sticks to that like glue and says, you know, you can just get 12%, you know, and you'll be good. I'm going, okay, this is a ridiculous, you know. It's amazing to me. Now, he does have a lot of good things that he says, but that's just not one of them, you know, personally.
Well, I do know that Dave doesn't like IBC or whole life insurance.
Well, I know, but when you really drill down into what he doesn't like, is he doesn't like final expense policies, because that's what he has in his mind when he thinks of whole life. He doesn't understand what we're doing. He has no clue. He doesn't like those policies that, you know, basically are horrible designs and, you know, just designed to no cash in them for years and no flexibility on premiums. You know, he doesn't understand reduced paid up elections. There's so many things that if you were to actually nail him down, he'd be like, yeah, I didn't know you could do that. But he will never admit it because his, you know, his whole thing is that he can't ever recount anything that he thinks, you know, I don't know how to describe it, but it isn't good, I don't think. I'll just tell you that this is the trick, is that people have to plan realistically to have most of their loans paid off by retirement, because you don't want to go into retirement with a big loan balance, right? And so that is something that I talk about a lot, is getting your loans paid off before you start distributing income in retirement. Otherwise, the whole thing is going to be accruing interest the whole way, and it's just not good, right? So there needs to be, for example, let's say a real estate investor would need to sell a property out of their portfolio and clean off the loans and then start distributing income. That would be one way to handle it, but don't just hit retirement with your loans, you know, high. You know, that's important to kind of harp on, because people don't get that in general. I found it's something that is a detail. So you're, David, you know, you're good not going into retirement with a bunch of loans. I'm not sure if you're ever wanting to retire, but I'm just bringing that up saying, hey, you got a bunch of policies you haven't used right now, you know, don't max them out and then start distributing money out of them.
Unless you have a nice, you know, retirement income like the federal government, military, whatever. So you can manage that properly. But you go back to the book, Becoming Your Own Banker. We started with that. Now let's kind of end with it. One of Nelson's coined phrases was "be an honest banker." Okay, and be an honest banker. And so, hey, you know, you're a mutual insurance company participating owner. Okay, so be an honest banker as you participate with the earnings of that insurance company. And what does that mean? Don't steal the peace, right?
Exactly. Yes. And that's easy to say, hard to do for a lot of people, you know. Sometimes, you know, it's the say do gap. People say they want to do this, but do they really do it? You know, I don't know. That's the thing.
Yeah. Well, that's the key to anything is human behavior, right?
Yeah.
But now that you've been doing this for a long time, and you've, you know, do you have any of those music stars come to you and say, how can you help me protect my wealth?
Honestly, David, that's a great question. And I don't really deal in that market. I mean, it's literally something I would have to target if I wanted to do that.
I mean, you know those people though personally, right?
I know. I mean, it's just, the thing is that truthfully, if I was just going to be gut level honest with you, they usually have financial, like they're surrounded by financial people. They kind of handle everything for them. And the last thing, even if you know them personally, they're going to be like, well, you have to talk to my gatekeeper, which is their accountant, usually is how they refer to him. You got to talk to my accountant. And that basically means that they don't have one clue in their head about any of this stuff, and they're letting somebody else handle everything for them. And it's just not, I know that is a potential market, but it's not something that I've ever been interested in pursuing, because now you're trying to break into this circle of people that are protecting the musicians, and then who knows, I don't know. It's not a market I'm interested in working in, to be honest with you. So the answer is no, I never even tried.